Welcome to this explainer. Okay, so you did it. Your bulletproof pre-approval shield worked. You passed the VIP security check for a mortgage, your credit is flawless, your income is verified, and you are officially under contract. But right as you step past that velvet rope, something intense happens. The automated underwriting system pivots. It stops looking at you, the buyer, and turns its cold, analytical gaze directly onto the physical house you are trying to buy. Here is our game plan for today. We are going to look at what happens right past the velvet rope. Compare the radar versus the detective, brave the appraisal gap nightmare, walk through 4 tactical levers to save your deal, and finally look at the future of the appraiser. Let's get right into it. Section 1, past the velvet rope. From buyer to collateral. Look, you've already proven you're a low-risk borrower, right? But the deal, it is definitely not safe just yet. See, to a bank, this house isn't some cozy home with a great backyard for summer barbecues. It's collateral. If the loan goes sideways and you stop making payments, the bank absolutely needs proof that this physical asset is worth every single penny of the debt they hold. Lenders have absolutely zero tolerance for being upside down on a house, so they aren't just going to take your word on the purchase price. They need undeniable proof. Which brings us to Section 2, radar versus detective, man versus machine. Since your entire deal hinges on this valuation, how do banks actually measure it? Well, there's this fascinating tension right now. It's literally a battle between man and machine. On one side, we have the automated valuation model, or AVM. Think of this like a high-speed data radar. The second your file hits the system, it instantly pings local data and public tax records. On the other side, you've got the traditional human appraiser. This is your physical walkthrough detective. They're carrying a clipboard, actively hunting for things the radar just can't see. Like hidden water damage or unpermitted renovations. Now, if you're buying a cookie-cutter house in a massive subdivision and the radar sees, say, 10 identical sales in the last 6 months, it instantly knows the exact value of your property. And if the machine trusts its own math, it spits out a property inspection waiver. Let me tell you, this right here is the absolute dream scenario. It means the bank accepts your purchase price as gospel truth without a human ever stepping foot on the property. It instantly saves you a $500 to $800 fee and literally shaves weeks off your timeline. But, and it's a big but, as we can see here, anything outside the algorithm's perfect little dataset demands the human detective. If the house has a unique layout, sparse data, or a complex history, the radar just can't see the whole picture, so it hands the file over to the human appraiser. And honestly, this handoff introduces immense risk into your transaction. All right, Section 3, the appraisal gap nightmare, when math freezes your file. This is the exact moment the human detective's findings clash with your expectations as a buyer. Let's anchor this in a real-world scenario. Imagine you fall in love with a house and agree to a contract purchase price of $450,000. Awesome, right? But 2 weeks later, the human appraiser finishes their detective work, crunches the local data, and submits a final report valuing the home at just $430,000. That is a $20,000 mismatch. Just let that hang there for a second. 20 grand. This is the exact moment instant panic sets in for most buyers. And here's why. Algorithms operate on one golden rule. The machine calculates your loan strictly on the lesser of the purchase price or the appraised value. Because the appraiser said the house is only worth $430,000, your maximum loan amount instantly drops based on that lower number. Suddenly, your financing is short by $19,000. And the nightmare becomes reality. The algorithm completely freezes your file. It outright refuses to fund your original loan amount. But don't panic just yet. Section 4, 4 tactical levers. The playbook to save your deal. The crucial point here is you are not helpless. We are going to pivot from being victims of a frozen algorithm to empowered negotiators. A frozen file absolutely does not mean the transaction is dead. If you hit this appraisal gap, you have a specific strategic playbook to manually thaw out your loan. We're going to look at weaponizing your contingency, splitting the difference, restructuring your loan, and fighting back with an ROV. Lever number 1 is aggressive but highly effective. Weaponize the appraisal contingency. If your contract has this clause, your obligation to buy is strictly dependent on the home appraising at the contract price. You basically take that low appraisal, hand it to the seller, and tell them, hey, the bank won't lend me the money. You leverage their immense fear of having to put that home back on the market with a known appraisal defect to force them to drop the purchase price down to that $430,000 valuation. But what if they flat out say no? Well, that brings us to lever 2, meet in the middle, sometimes called the split strategy. If the seller refuses a full price drop, but you happen to have the extra liquid reserves, you compromise. The seller drops the price by $10,000 and you bring an extra $10,000 in cash to the closing table to patch the gap. Lever number 3 is where we actually restructure the loan architecture itself. Say you planned on a 10% down payment. You pivot to just 5% down on the newly appraised value, and you use that freed up liquid cash to cover the appraisal gap out of pocket. But I want to be very clear here. This is not a free lunch. By dropping your equity, you are borrowing a higher principal amount and triggering private mortgage insurance, or PMI. You are essentially trading immediate deal survival for a long-term cash flow drag. Which brings us to our fourth and final lever, the reconsideration of value, or ROV. This is where you actually audit the human detective's work. If you find they made a massive objective error, like maybe they completely missed a finished basement or ignored an identical perfect house that just sold next door last week, you can file a formal appeal using hard data to force the bank to revise that valuation upward. When you compare the real financial anatomy of your choices side by side, the trade-offs become super clear. If you fully renegotiate, you need zero extra cash and your monthly payment actually decreases because the loan is smaller. If you use the cash patch, you're out $20,000 extra in cash up front, but your payment stays flat. And if you use the pivot strategy to restructure your loan, you need zero extra cash today, but your monthly payment increases because you trigger that higher PMI tier. It is all about balancing your immediate cash against your long-term monthly goals. Section 5. Future of the appraiser. Extinction or evolution. Now that we've mastered the tactical playbook, let's zoom out for a second. There is a massive technological shift happening right behind the scenes of these valuations. These high-speed AVM radars are getting smarter every single day. They are ingesting absolutely massive amounts of proprietary real estate data, and as a result, they're issuing more of those dream scenario property inspection waivers than ever before. And frankly, this rapid advancement poses a very real threat to the traditional human appraiser industry. Which leaves us with this final, absolutely fascinating question to consider. The tension between man and machine is only growing. But if traditional human appraisers do eventually go extinct, how will an algorithm ever accurately value a truly unique, one-of-a-kind home? Think about that the next time you look at a piece of real estate. Thank you so much for joining me for this explainer. I hope it gave you exactly the tools you need to conquer your own appraisal battle. Keep learning, and I'll catch you next time.